So today we have the privilege of talking with Peter Finley, who is our head of institutional capital markets. And Peter has been an industry veteran and has seen through the market cycles how our industry has handled itself. So we're glad to have you here today. And I always love to start out by asking, how did you get into this industry? What was kind of your path into this space?
Sure. No, thanks for having me. And it's great to be here in sunny Modesto. So, what happened, well, I was in the Navy and I decided there had to be more in life. And so I went back to business school. And at the end of business school, I was fortunate enough to get an offer to work at Goldman Sachs in the real estate investment banking group in New York.
I've heard of the firm.
Yeah, kind of like the logo.
Yeah, small firm.
Graceada with Goldman and Blackstone.
Yeah, exactly.
But and so I was there for 4 years, and in the early 90s, there was the whole S&L crisis and the RTC, and this was before the opportunity funds were born, which happened a year or so later, and our group went from 100 to 50 overnight. And People. Oh, yeah. And we were the first layoffs Goldman ever had, and they were a partnership at the time.
Wow.
So, probably I had the best training. I went to work for Equitable Life for the CIO to do the workouts of the general account real estate portfolio. And there I was able to learn really about the substance, how the widgets were made, whatever. And it was really interesting. During that time, I met my mentor, Paul Dolinoy, who is now on our advisory board.
Yeah,
and so after 4 or 5 years of doing workouts, I decided to join the game again and go back to the street. Times are good again. So I was doing general like M&A banking and just real estate banking. And what we did at the time I was at JP Morgan, we did a go private with a public company called First Washington. They were out of Bethesda, Maryland, and they were a shopping center company. We did it with CalPERS. And just because the gentleman running CalPERS at the time was a former colleague at Equitable. And so we did a go private, and I said, boy, there's something to this business. And so so that really started the private equity focus. And in 2003, I got into this game full time, just raising capital for commingled funds. A friend of mine who became the global head of real estate at UBS Investment Bank recruited me, and a gentleman who ended up being my partner. We built the group at real estate, for funds for UBS. And did that for a bit, and then I went to I guess it was the 2009 during the GFC. I went to the principal side. And was fortunate with some great firms.
And you've liked that ever since, for the most part, right?
Yeah.
It is different because I respect the capital raisers who do it on behalf of multiple firms, because it's a different skill set, because you're kind of having to figure out which strategy and which firm aligns with which LP. Whereas when you're on the GP side, you have a firm that you work with, a strategy, and I feel like that, at times creates a lot more focus and clarity versus, kind of working for multiple firms and trying to raise capital for multiple. I don't know how you feel.
Well, let's put it this way, it's great training ground to be an advisor and really figure out things. And to me, there are always 3 key things. Before we took on an assignment, what's the value proposition? Number 1, 2, can the GP execute? And 3, can you find the capital? And there were, mistakes along the way. And but once you develop that and do it for a while, then you have a real strong, call it radar, as to what can be successful.
And that's probably something when someone is earlier in the business, they haven't developed that conviction level around all 3 of those, as well as someone who's had more experience and learned, when capital might be scarce or hard to raise, or when a GP doesn't have what it takes to execute, or when the strategy isn't a right fit for the market.
It's very similar to a acquisition person becoming, whether he or she starting out and then really learning 12, 15 years later, okay, I lost $50 million. Now I'm not going to repeat that mistake.
It's very similar. Well, you've been in the industry through market cycles, and I'm curious, how would you say that you've seen the institutional landscape change over that period of time?
It's really interesting when the market started, when the opportunistic funds started in the early 90s. Let's just say the terms were very GP friendly.
Yeah.
Whereas the waterfall, instead of being like the European waterfall, they were, deal by deal waterfall, and there was not always the true up at the end.
Oh my gosh.
And also the subscription lines.
Yeah.
There would be funds out there that would basically not call capital, utilize a subscription line for 2 to 3 years, deploy all fund capital, then call capital at the end. And that changed. But I have to hand it to the consultants, because this is where they really stepped in.
Yeah.
They brought a lot more transparency to the process and discipline. So it's really become much more of a disciplined industry.
Well, there are a lot of parallels. I'm even thinking of the CMBS market. The CMBS market was relatively new, call it in the late 90s and early 2000s. And then we went through the GFC and we learned what worked and what didn't work. And it's kind of like every industry or segment, it goes through this kind of infancy that you could call the Wild West, or you could call it just, where people are still learning and figuring out what works, what doesn't. And then it gets to kind of this more mature phase.
Yeah.
I'm curious, during that same period of time, what have you seen in the industry that has remained the same? What aspects of the industry haven't changed during that period of time?
Honestly, it's very clear. It's the misuse of leverage. And I probably am upsetting people who are, that's their business, but it's the misuse of leverage. When leverage is utilized as a foundation to your strategy to generate the returns, you're putting yourself and your investors at risk. It hasn't been learned. I mean, you can look at, it just hasn't been learned over the cycles. And we certainly experienced that the past few years. And it's happened, 3 cycles before that. And it will happen again.
It's very true. It's like a pendulum. I often say that bad debt makes good borrowers make bad decisions. And it's true. You can have all the intent in the world and you can have a business plan that you plan to execute on, but the type of debt that you layer onto that and the level of debt, the leverage, can have a magnitude impact on that.
Yeah, and unfortunately, many investors have lost quite a bit of their equity over the cycles because of that. It's like people get lulled to sleep. You have the time to buy. Then you have a period of stability. Maybe it's numbers, 5, 6, 7 years. And during that time period, people forget. And then the problems, something that's not in your control happens.
Interestingly, as we get, because the market always operates in cycles, as we get closer and closer to kind of peak market, that's the period of time when people should be delevering, not increasing leverage. And usually it happens exactly the opposite as you get closer. Hey, I can't make the numbers work. Well, let's throw on a little more debt. Oh, now the returns work, It's exactly the opposite of what a prudent investor should do. So I'm curious, you passed over Navy a little bit. You mentioned you were in the Navy. I happen to know that you are a Academy grad, Annapolis. I'm curious if there were any skills or experiences or wisdom that you learned during your time either at the Academy or as a naval officer that translated into your practice either today or early on in your career.
That's an interesting question, and I haven't thought about it, but the clear answer is yes. And really what it was, without talking a lot about it, I was in, call it the P3 community, which was the sub-hunters. So we used to chase the Soviet submarines in the Pacific and the Indian Ocean.
Wow.
And so as a this is a few years into it, as a 27-year-old individual, like young lieutenant, I was responsible for a 13-person crew, and we would go chase the submarines. And there was like no oversight. And if you lost that submarine, the admiral and the chain of command would know about it. And so there was a lot of pressure with that. But what was interesting is that if you thought I was well trained, had a little above average ability, why not take the risk?
Yeah.
I mean, it had to be done. And if you and it wasn't, the funny thing is there were 13 of us.
Yeah.
So it's kind of like real estate. We all had our specialty.
Yeah.
And if one of us dropped the ball, it was a problem.
Yeah.
So I mean, that was the thing. It was at an early age being responsible for something of value.
Yeah, and that they're very similar to what we do today. Obviously, fortunately, we're not dealing with keeping track of nuclear warheads, but millions of dollars of investment dollars is its own thing. I'm curious also, as you know, our strategy is kind of in the process of gaining broader institutional acceptance. What experience have you had with that in the past, and are there any insights that you bring for that process of kind of an evolution of strategy acceptance within the market, within the broader marketplace?
Probably the best fundraising experience I had was 2004, where I was the co-head of the group at UBS. And Richard Ressler of CIM walked in the door and said, hey, I have this relationship with this California fund, but I want to do commingled investments. Can you guys help me to raise a fund? And, it's like the principles. The principles are, is there a value proposition here? Yep. There was a significant proposition. Yeah. Does he have the ability to execute? Yes. Is there market acceptance? Maybe. We didn't know. It was 04. And what Richard would describe, he says, look, and part of the thesis was, look at LA, it's a donut. The hole in the middle is downtown LA, the CBD. Yeah. There is no, there's no 24-hour vibrancy, no assets down there. Yeah. He says, my vision is to bring, the experience, integrated experience to downtowns. Yeah. LA was an example and others. And we thought, my God, this is just so, it was so clear, but we didn't see it. Yeah. No one saw it because there wasn't. So
urban core investing was not a thing.
It didn't exist. Yeah. And so here we are, 2004, feeling great about him and his team. We went out to the market, and we had a whole team of people. Yeah. And after 7-8 months, we were getting no traction. Yeah. And this was crazy. Richard is saying, "Look, what's going on here?" And I says, "Yeah, I know. What is?" But we had all this data, and what happened is, it was a little bit by chance. A good friend of mine, former colleague at J.P. Morgan, Linda Asante, she was at Townsend at the time, and she was doing she thought of this idea about urban investing, and was putting together a research paper, but she needed research. Boom.
You had the research.
We had the research. And, after they did their diligence on us, the only time in my life we got this out of Townsend, but $500 million of commitments from discretionary funds, and we were off to the races.
Interesting.
So the interesting thing about that is, and this is the thing that attracted me to Graceada, I knew about the company 5 years ago. You may not remember this, but I worked with Heather Border. Yeah. She's now co-founded Alliance Global. Heather and I worked together. Yeah. And then she went out and created Alliance with Jen Stevens.
Yeah. A great organization who has been a big influence on us.
You were the first client, and Heather asked me to be a reference for you. Which small world. Yeah. So that's how I initially got introduced to the platform. And Paul Dolinoy, my mentor, has been on the board. Mm-hmm. And Paul, as we know, probably from, if people have looked at a previous podcast, he's been on the NYSTERS Real Estate Advisory Board 23 years, former president of Equitable Real Estate, real mentor to many of us. Yeah. And Paul would keep me in the loop. And then when I recapped my last company, which we know, Paul was like, there's an opportunity. It's just like you like. Really.
Yeah. Yeah, because that infancy in
the value proposition is there. The team can execute. Yeah. And what's really turned the corner for us, initially we went out there, and we kept hearing from people, many of my friends. Yeah. There's no liquidity in your markets. Yeah. Okay. Then we had that white paper. Yeah. And that was
demonstrated
done.
It wasn't.
Then
true.
We come back again. There's no economic vibrancy. Okay. We ended up doing the paper. We have more than LA and San Francisco. Yep. Then the third one was real estate fundamentals. You guys perform poorly during periods of economic stress. okay. So he came back and it's like, strike three, boys, you're out.
Yeah. You know, it's interesting because on the one hand, we could be a strategy that is a well understood and defined strategy. And then what you have to do is focus on why you're the best manager for this already understood strategy. What we have is a strategy that's different. And so in a sense, instead of spending a lot of time demonstrating why we're the best in an already understood strategy, we're spending a lot of time, like you're saying, essentially talking about why this strategy is of value to an investor.
It's what we call the Howard Marks play.
Yeah.
Is we can produce outsized returns without taking outsized risks.
Absolutely.
And because you cannot get, and this is what's really helped us with people, is if we're able to generate these returns, like we talk about a net 17 plus, net to multiple, at a leverage level that's under 60%, and I mean, that's a value proposition. The other thing too, because our asset size is so small, 40 million or below, we stay out of the radar of all of the institutional money managers because that drives up the price, all that competition, that drives up the price of the assets. And so we don't have that competition. And we've you and Joe have been in the market 17 years, so we have the credibility, the infrastructure. And so it's a great play. And you know, we've got, without making too much of a commercial, we have some great running room.
Absolutely. Well, you know, I'd say as we're rounding out here, you've been in an industry for a while and you've learned a lot through that process. What would you say to someone who is new in the industry, in capital raising in particular, or someone that's thinking about getting into capital raising? What advice would you give to that individual?
What I would say is learn how the widgets are made. You cannot really be an effective marketing person and selling widgets if you don't understand. What really helped me was doing the workouts for 4 or 5 years. So what I would say to a young person today, if you have a chance to go to Heinz or to one of the big money managers, go there, learn about the fundamentals of the business, because ultimately you're only going to have a short window to talk to LPs when you're actually on the spot raising capital, responsible for it, when your company's looking to you. So you have to be able to deliver the pitch succinctly with knowledge and to have credibility. That's the best advice I can give to someone starting out.
That is great. Well, Peter, thank you for taking the time today, and this has been a great opportunity and conversation.
Oh, it has been. Thank you, Rick.